Good morning, everyone. Hello. Please do come in, take your seats, shuffle along. We are very busy today, so please do get comfortable with your neighbour. Welcome to the 9th edition of the London Real Estate Forum. My name is Benjamin O'Connor, and I'm a director at New London Architecture, who run the forum. NLA is London's centre for the built environment. We bring together built environment professionals, politicians, and members of the public to learn about, debate, and ultimately have a voice on the future shape of London. This year, we have a slight shake-up to the LRF format. We kicked off yesterday with our Opportunity London conference, where we convened senior leaders across the public and private sector to discuss London's key opportunities in the face of some major challenges. Today is our main conference day. Some of you may remember our focus last year was on resilience, and we heard a lot about the short to medium-term interventions being made by the sector to combat the impact of Brexit and the pandemic. This year, our theme is Think Beyond, where we'll hear more about the longer-term approach and plans being made across a wide range of topics impacting the built environment. And finally, tomorrow, we'll be taking LRF on tour, exploring 11 key opportunity areas around London. So finally, before we kick off with our State of the Market session, I just wanted to do a bit of housekeeping about where all the sessions are going to be happening. So we're on 4 stages this year at the Barbican instead of 3. You're currently in the hall stage. If you come out of this stage and walk to the left side of the city model, you'll see a glass door on a street. If you cross that and go down the stairs, you'll be in the cinema stage, which is our second stage. Then there are a set of stairs and lifts that can take you to the 4th floor, where you'll find Frobisher Auditoriums 1 and 2. If you're going to be attending the Next Gen reception at 5:30 today in the conservatory, then that will be accessed through the 3rd floor garden room. And lunch is going to be served both on the lower ground floor by the city model and also on the ground floor in the main lobby area. If you didn't understand any of that, it's fine. We do have event staff posted around in LRF purple, and there is signage everywhere, so hopefully you won't get lost. Well, listen, thank you all for coming, and please do enjoy the day. I'm now going to hand over to Alex Note, who's Placemaking and Investment Director at PFP Capital, who'll be chairing the State of the Market session. Alex.
Super. Thank you, Benjamin, and good morning, everybody. I am delighted to be here for my 3rd time chairing this State of the Market session. Frankly, I was quite tempted to bring a mystic mega wig and a crystal ball for everybody, because we're kind of in that kind of a situation where predictions are a risky thing to make, but we have a supremely expert panel to help us through. The way we're going to go is have a keynote from our Chief Economist, Ian Stewart from Deloitte, who's going to just give us a few minutes of his initial thoughts on what on earth is going on. And then we'll have a bit of a conversation with the panel up here, who I'll introduce shortly. We'll then go into a Q&A with you. We're going to have 4 roving mics across the room, who I will ask to put their hands up when we get to that point. So if you would like to ask a question, we're doing it old school, please stick your hand up and wait until the microphone comes to you. And please make them questions, not comments, just so we can try and keep it engaging. That would be super. But Ian, I think to start us off, could you tell us your thoughts, please?
Yeah, thank you. Good morning, everyone. Actually, it's quite fun being an economist at the moment. You know, things are quite interesting. I mean, just some sort of thoughts about where we are in this cycle and how Friday's events, you know, will affect things. I mean, I think it's been clear really since about spring of this year that Europe and the US were going to see quite a material downturn in activity through this year and into next year. And I think what's changed in the last 3 months is that central banks, which came into this year seeing inflation as largely being a kind of an extreme but transient phenomenon, have come to worry a lot more that inflation is embedded in the system. And I mean, this is true of economists too. I think we've all been too optimistic about inflation falling out of the numbers as you see the effects of the dislocation caused by the pandemic, the war in the Ukraine, supply chain problems dissipating. So I think in the last 3 months there's been a big shift clearly in market rate expectations and a commensurate shift down in expectations for growth. So I mean, it's really quite something when the Bank of England in their last inflation report went out and told us there was going to be a recession. I don't ever remember the Bank of England actually forecasting a recession before it's occurred. Actually, generally economists don't forecast recessions before they occur. They generally forecast them once they've happened. But the So I think this is, if we are going to see a recession, which I think is very likely, this is the most sort of signalled recession in 50 years. We've had a lot of warning about it. And of course, into this mix came on Friday the fiscal event. And I mean, I think that, at times like this, when things are very surprising, people reach back in kind of history for precedents. We had an economic historian from Cambridge with us at Deloitte yesterday who was talking about the parallels between now and the budget of 1972, Anthony Barber's budget, the Dash for Growth, in which Ted Heath's Chancellor announced a big increase in borrowing to fund public spending, an aim of raising the growth rate, just like this government's, and it ended in a lot of inflation. So, I mean, I think this is was a remarkable statement because, in essence, with an economy that is running hot, and I mean, I think probably most people here will have had the same experience that we are having at Deloitte in terms of the labour market. This is a really tight labour market. Most of the data that we can get on capacity utilisation tell us that we're at the top of the cycle. So into that economy, we've had £45 billion of tax cuts. And of course that massively complicates the task of the Bank of England, to put it politely. And for the first time in a long time, fiscal and monetary policy are operating at cross purposes. And of course, the market verdict, I mean, unsurprisingly, is this means higher rates, and why wouldn't it? When you have an overheating economy into which a lot more demand has been injected. And obviously the bank has kind of resisted any detailed comment, but it's quite clear from the comments of the chief economist, Hugh Pill, yesterday, that he's talking about a substantial, a significant monetary response. Well, clearly that's what markets are pricing. So I think the economy may well already be in recession in the UK. That's what the bank's view is. But I mean, if it is a recession, it's a pretty mild contraction. I mean, we think the recession will run through most of next year, probably end towards in the fourth quarter of next year. And actually, I mean, in terms of thinking about recessions, I mean, they are very frequent events, of course. I mean, we had the biggest ever in 2020, which is, no template. But if you look back at UK recessions over time, and you exclude the pandemic, they generally take about 5% from GDP. So I suppose another way of thinking about it is that 95% of the economy is unaffected. But a 2% contraction, which is what we expect, would be on par with the recession of the early 90s. And that, of course, was the last recession that we had, which was induced by inflationary excess. And this is certainly one of those old-fashioned recessions caused by inflation. So, we think that, I was doing economics at the time, and that recession certainly didn't feel mild. It was a long recession. You saw quite a big rise in unemployment, and you also saw a lot of disruption to the economy and in the housing market. So I don't want to underestimate the effect of a 2% contraction in GDP, but I mean, by comparison, the global financial crisis, UK GDP contracted 5%. So I think that we're at this sort of stage, and I have a lot of conversations with clients who are saying, well, actually in our world, we've had a great year, labour market's strong, things look pretty good. And I think that there is a bit of a disconnect between how businesses feel in general and how consumers feel. Consumer confidence is on the floor, it's at record lows, business confidence is much higher. I think that's going to change over the next few months. I think we're going to see corporates shift to much more a defensive stance, a focus on cash, on cost control, on strengthening balance sheets. This is, of course, what corporates do. I also think, as we think about recessions, what is clear is that they accelerate change. Of course they do. And of course that creates a whole set of risks, but it also creates opportunities to do things in different ways and opportunities to change business models. And I think that's one of the things. We saw that during the pandemic. It caused wholesale implementation, a step change in working from home. I think we'll see some pretty big changes coming out of this downturn. And of course, the other thing that comes out of recessions is that it widens the gap between the top and the bottom performers within sectors. So divergence increases. So the premium on good decision making increases. And the thing that we emphasize with clients is that recessions are like the weather, but there is a huge range of performance of companies in recessions, and it's got a lot to do with the decisions they make. So I think that businesses have a great deal of agency, a great deal of control, even in a situation of a recession. I think the other challenge for corporates will be to manage the question of how you balance these short-term priorities. What is Sterling doing today? Is there, are we going to see another big announcement with kind of longer-term themes that when this recession is over, I know we'll all be talking about around tech transformation, climate, cyber, resilience. And so, I mean, that's really it. Actually, just one final note. Before I came here, I just checked what's happened to employment in your sector, in the real estate sector, over the last 30 years. And you'll be pleased to hear that it's grown much faster than any other sector in terms of jobs. And through recessions, real estate has added employment's risen 250% over the last 30 years. That's far faster than technology, financial services, or pretty much any other sector. So, I mean, whatever's happening in terms of recession, I suspect in a year or two's time when you have this session again, there'll be more of you than there are today. And with that thought, I'll hand back to Alexandra.
Super. Thank you, Ian. And yeah, in such a turbulent time, thank you for taking us through some kind of things that we can hang our hat on a bit. I just wanted to ask you, the IMF obviously have come out and urged the government to reevaluate the announcements already made. Do you think that there's going to be a bit of a doubling down on this kind of policy, or do you think there might be some subtle shifts coming this week?
I mean, it's clearly very difficult to pull back a 45 billion.
Yeah.
That
it's quite a U-turn if you were going to do that.
I mean, it's like governments like to change course subtly, but I mean, this is a big one. So I don't think so. I think what they will try to do is firstly emphasize the kind of wider rules and fiscal rules within which this is set to try to restore some measure of confidence, because we're operating without a sort of fiscal playbook, and although governments have repeatedly changed the rules on the guidelines, there isn't one now. So I think they're going to emphasize that. And I think the second thing is they are going to really push the wider aim of the government around the supply side and deregulation, and that this is part of a wider package. I think so. I don't think they're going to pull back in terms of the measures.
And on that wider package, we all know the truism that the markets hate uncertainty, and this kind of dangling of, there's more change coming. Do you have any thoughts about what those additional changes might be? Well,
I mean, I was involved in politics under the Conservatives, and deregulation then was a really big thing. And I mean, I think everyone agrees in principle with deregulation. The practice of it is extremely difficult and tends to be long-term in nature and hits a lot of political obstacles. So I don't know. I think the other thing, of course, that can happen, Alexandra, is that the Bank of England can go big on a rate rise, which I think that is, we've got to assume it will be a big move when it comes, and whether it's at the next meeting on the 3rd of November or whether it's before, I think it will be large.
And Janet Yellen is certainly talking about the need for that kind of action to be taken. So it'll be interesting to see if they listen.
Yeah, exactly. So I think that I think with hindsight, it's surprising the bank didn't raise more aggressively on Wednesday, and you wonder whether they had sight of the fiscal statement. It would be rather odd if they didn't, but perhaps they didn't. But there's quite a lot of catching up to do.
Okay, interesting. Thank you so much, Ian. We'll bring you back in shortly, but I have a wonderful expert panel here to help us cover the full spectrum of our kind of real estate and built environment world. So to my left, we have Becca Heron, who's the Strategic Director of Growth and Development for Manchester City Council. In the middle, we have Robert Evans, Joint Managing Partner at Argent LLP and Partner at Related Argent, and Alexander Yan, Chief Economic Advisor for London Property Alliance and Chair of the Central District Alliance. So Alexander, I might start with you if that's okay, but just in terms of that, what it means for real estate and London in particularly, LPA, you've been doing an awful lot of work on the kind of competitiveness side. Are you able to give us a few indications into that? I know it's not out yet, but...
Okay, thank you very much, and thank you to you for an excellent introduction. I have to confess I'm also an economist, but I'll try to keep the argument to two hands rather than three hands in terms of any debate. So as Ian has set out, on the one hand, it's clear that the government has gone down what might be called a slightly unorthodox route in what it's done last Friday in terms of some of these big packages on taxation and indeed using borrowing to fund tax cuts in particular. But on the other hand, what I think is quite interesting from a London perspective is the fact that the government and its advisors will have worked out that if they want to have this relentless focus on growth, whether we kind of like it or not, this was true before when they were interested in pursuing slightly a different set of policy objectives, a more nuanced set, London is going to have to sit at the centre of that policy in order for it to be successful. And the two things that struck me about the statement on Friday was one, just analytically rather than politically, London was something, a place that the Chancellor was prepared to mention in positive terms. He talked about, whether we like it or not, he talked about getting bankers from other cities in the world to move to London. So he talked about London positively, and he also talked about London competing on a world stage. And those two things are both things that I think we should somehow find a positive, constructive way of tapping into without forgetting the very, very important challenges in terms of regional inequalities and the levelling up agenda and so on. And the second thing that was very interesting about it was when you looked at the actual impact of the tax changes proposed, Resolution Foundation's done some great work on this, nearly, the vast majority of those impacts are in London and the southeast. So I see positivism in there in the sense that I think the London brand, as we were saying before, is perhaps a little less toxic. I think the focus on growth is very good for London. I was at the Labour Party conference earlier this week. They are now talking about growth in positive terms as well. So there's something I think we can really welcome there. And what we have to do next, I think, is think very carefully about the right asks in order to allow the growth agenda to succeed.
Super. Thank you, Alexander. Becca, Alexander's mentioned levelling up. And we've had this kind of white paper. 2-3 years ago, we had a conversation here with Tony Travers, who said that his concern was that levelling up for the UK meant levelling down London. And I think what you've touched on there, Alexander, shows that perhaps we've moved away from that. But we saw that the Northern Powerhouse Partnership last week noted that foreign direct investment into kind of that region had gone up 72% in the past 5 years, Becca. So you've seen a huge influx, and that's obviously something you want to maintain. But where are you guys sitting in Manchester in looking at this?
So, I mean, I don't believe that levelling up the north means levelling down for London. I think, in very few developed countries you see such a centralised economy, and I do think it's to the detriment of the UK as a whole. I think we are disappointed that in the sort of lack of reference to levelling up. The white paper was finally launched in February. Haven't had a government for long since then, and it certainly hasn't featured very heavily in Liz Truss's campaign. I don't think that there's anything to object to in the white paper. The 12 missions are sensible. They are things that Manchester and Greater Manchester have been asking for quite some time. We need a focus on driving productivity. We need investment in R&D beyond the southeast and a greater share of that investment. Transport connectivity is key. HS2 bill is moving through Parliament and we are petitioning quite heavily for a solution that really does benefit Manchester and the wider north. I think for me it's what sits behind that, and I think it remains to be seen whether there is an appetite from this new government to really drive that levelling up. Greater Manchester, along with the West Midlands, are a devolution trailblazer. Again, sort of not long after that announced, we were without a government to all intents and purposes for quite some time. Those conversations have now restarted. But ultimately, we can talk about additional powers, freedoms and flexibility, but for us in Greater Manchester in particular, it is very much about certainty of funding and the ability to influence more how that funding is deployed and how we align that funding. We're watching with interest on investment zones and some of that, streamlined planning, for example, and some of those tax incentives. It's still very high level at the moment, and we don't know what that means in practice. But I don't believe that levelling up means levelling down for London. I think that there's an awful lot of work to do for all of us in terms of responding to some of the changes we've seen over the last days, in some cases, and months.
But is that age-old sort of challenge and tension between local authority, central government for that influence, the funding, the powers, is still something that isn't being resolved quickly in a way that allows you to act?
No.
So no, we need that.
No.
Super. We'll come back to some of those points. Robert, I know you've got some thoughts on kind of London and the regions having worked across that, but I just wanted to work to what Ian referred to about the role for real estate in the growth agenda, and what your thoughts are there.
Well, good morning. I think the real estate industry obviously has a very important role. Some of the points that Becca was referring to around transport, R&D, creating the right floor space for the growth industries that we're all focused on, both in London and elsewhere, how we remodel local public services, how we create the place leadership to create the right places to allow growth. And one of the big challenges I think the government rightly have highlighted, I might only go this far in terms of what they've done so far, but the highlight on productivity, I think, has been right. I mean, one of the big challenges we face in London, but frankly more outside London in some of the other places, is how to grow productivity. In the UK as a whole, UK cities lag behind the average, whereas in most European countries, the big cities lead the average. You can put London outside that statement, but that's a real challenge that we have in the UK. So actually, if we want to level up and we want to achieve all the things that we want to achieve, greater growth, actually targeting productivity gains in our big cities outside London is actually really, really important. That's where we can make the most sort of bang for our buck. And that does come down to the things that we've talked about: improving transport, getting more people into the cities easily within 30, 40 minutes, better focus on R&D, city centres that are more equipped for the knowledge economy, better public service, etc. The real estate sector has a really important part to play. That's not to mention, of course, affordable housing, a credible path to net zero. Ultimately, successful cities will be judged by these things going forward, whether it's by investors or others. Cities need to be able to respond on these. And to those two challenges, net zero and affordable housing, the real estate industry is absolutely pivotal.
And we'll certainly come to those, but just staying on the kind of investment side. So for all of you, we know that for those of us who work in investment, they've been frantically repricing deals while interest rates have been moving in interesting directions. But you're dealing at Argent and with related Argent with US and Australian investors. Are they seeing us as a kind of bargain or a basket case? What's the kind of price discussion here?
It means we don't get any sleep because the clock means that we're on the phone.
You're just on it all the time.
On the phone the whole time, yeah. I mean, I don't think anyone knows yet. I don't think anyone's used those words to me, bargain or basket case yet. But we have, all I'll say is this, we recently closed a big refinancing on King's Cross.
Yeah.
And I'm glad we did it then. That was a little while ago, a few days ago. Certainly as regards to hedging was concerned, I'm glad that we got it done when we did.
The numbers are easy because it's now a pound to the dollar, right?
Yeah. So. I think it's, and even before the recent Friday, what was the phrase, fiscal event, I think you said.
That's right.
Even before that, it was clear that as we ran that process, the number of parties in the market was reducing, the pricing was going up, the hedging was becoming more complicated. So we started it at the right time and we got it done, but I think it has got progressively harder, and I think Friday has only probably added to that. I mean, clearly on the dollar to the pound makes us relatively cheaper for some people, but you still have to believe that the investment, the yield ultimately justifies the risk, and and you have to believe in the product, and you have to be able to, look at it as a good investment. So I think the jury's out on that. I think a lot of people are sitting on their hands at the moment. I don't think they've made a conclusion that anything's a basket case, but I don't think the people we're talking to would rush to put huge amounts of money into the UK right now.
So again, as ever, we have this bottleneck of, the wall of capital that we've talked about for so long that wants to get into UK real estate.
Yeah.
Just has another set of...
But just on Ian's point, I think it's partly about what they've done. The shift is quite dramatic, as you say, compared to previous policy, and our industry loves certainty, as do all investors. But I think it's also not just what they've done. I think it's partly the way that they've gone about it. I think it's come across as quite gung-ho. They haven't published the fiscal data that normally you'd see from the Office of Budget Responsibility. It's come out ahead of that. They're now sort of backtracking slightly and talking about it coming out in November. So I think it's partly just the way it's come out. It's sort of come out as a bit sort of slapdash and a bit gung-ho. And I think the market's reaction is partly the style of how it's been done, as well as the content of the fiscal change.
Absolutely. Alexander?
Yeah, I mean, without wanting to underplay the sort of dramatic and unprecedented nature of some of what Friday was about, we have kind of been here before. Even I'm old enough to remember, Black Wednesday and the 1970s and the telly, we were lucky enough to have one going off at 6 o'clock with the WPTU, Eric Hammond, rest his soul, going on strike and all the rest of it. So we have been here before in many ways. For me, from a London and a real estate point of view, I think we have to kind of be very tactical with government in order to, and indeed other big cities, Manchester as well, in terms of trying to put it bluntly, get what we want out of them by demonstrating an alignment with their agenda. And it's very interesting that tax-free shopping, my bid sadly doesn't have all the fantastic retail of New West End Company, sweet shops included, and indeed Heart of London. But the tax-free shopping decision was a surprise in some ways, but it is a policy which will benefit London retail largely. It will also potentially benefit the regions because EU visitors will be able to take advantage of it. And that is a good example of a policy where I think London will benefit, whatever else happens. The other ones, I think, are around the enterprise zones, as has been mentioned. I think we do need to do something to take advantage of the Elizabeth line. We've just spent all this money on the Elizabeth line. It's got fantastic potential to bring more people, 1.5 million people, more people to within 45 minutes of central London. We've got a big challenge on productivity, as Ian has mentioned. So maybe, is there some form of very tightly drawn enterprise zone we could have running from Marble Arch through to Liverpool Street to deal with the vacancy rates at ground floor level, which my bid has got, Tottenham Court Road, Oxford Street, and so forth. So I think we have to be really clever and selective in focusing on those things that we want, and let the government, in on that because it's part of their agenda. And I have to say, let's add to that extending the Bakerloo line, which is in terrible need of upgrading, and its extension would deliver more homes and jobs, as indeed, dare I say it, would Crossrail too.
Okay, thank you. Ian?
Yeah, I really agree with this point about...
You can't agree with another economist.
I know,
That's not
economists
allowed.
like agreeing with each other. But this...
That doesn't happen.
Yeah, there is a butt coming. I think the debate about productivity is so old. Actually, I've just been reminding myself of the history, but back in '72, Heath and Barber were looking at the data for the 1960s, saying, why is the UK the slowest growing country in Europe? Let's do something about it. Well, they did. They crashed the economy. But this is a...
Did it work?
So obviously you saw a re-rating of productivity in the 80s and early 90s, and you've seen a de-rating of UK productivity really since the financial crisis. But the British have been arguing about this for a very long time, and we always end up talking about training and education,
skills,
infrastructure, stable policies, and the supply side generally. In the conversations we have with government, what comes over is they are looking for solutions rather than more analysis. And actually, I'm happy to add to the mountain of analysis, but I think the real question is, what is it you can do? What levers can you pull? and what practical solutions are there that are realisable within the lifetime of the average minister. And I think this is why there is a premium on action rather than more analysis.
Critically, average minister rather than average housing minister, which is a considerably shorter shelf life. But okay, Robert, very quickly, and then we'll move to Becca on a different topic.
I mean, I agree on that, but one of the things that strikes me, as particularly in the levelling up context, is the money that we see advertised are relatively small amounts of money in the scheme of things. When you think that, I don't know what the Germans have spent on reunification, but it's $2 and a bit trillion, dollars or pounds, probably the same thing there. And we're looking at 4 or 5, billion, here or there to talk about levelling up and so on. So the numbers we've so far identified are relatively small beer compared to, a real programme of levelling up and making part of the country much more economically levelled up to another part, which happened in Germany. So, to my mind, one of the key questions is how do we just get more investment? How do we create a bigger pot to actually play with? And I think, certainly in a London context, I think there are things we could do. I mean, we're part of Opportunity London, as others are, to try and make London, a more coherent story to investors. But I think we could go further on that. I think London could look at, how London could present itself, rather than talking to investors such as yourself, Alex, and saying, look, why don't you look at this site in Croydon, or this site in Camden, or this site in Barnet, and so on? Why can't investors invest in London as a whole, alongside the city, some kind of London bond or instrument? I mean, I don't, there's thousands of reasons why that might not happen, but I do think we have to think about bigger solutions, because the amount of money we're talking about and arguing over is comparatively small compared to the scale of the issue.
Absolutely. And actually, Becca, that's something that Manchester did phenomenally, under the kind of Bernstein era, that, of branding Manchester to kind of overseas investors as a coherent sort of piece of investment in its own right.
Yeah, and I think we are still sort of moving forward in that way. I think it goes back to, I can't remember who said it, but being able to respond to the government's agenda. I think Manchester has always been quite good at positioning itself, looking at what the government is looking for, and aligning wherever we can our objectives with theirs to deliver. And I think there has been a huge shift. We've seen a huge amount of investment. Confidence is good. I think we've been actually sort of pleasantly surprised by how demand has held up in the city since the pandemic. But demand for commercial and office space is still high. I think possibly we're benefiting from a move away from the southeast. Demand for residential is really, really strong, particularly in the city centre. And actually now, after, I started work in Manchester 20 years ago when we were looking at issues of low demand and lots of empty properties, now we're looking at affordability. But it is about where next. And you referenced Crossrail 2 earlier. We're fighting to get the right solution for high-speed rail and Northern Powerhouse Rail. And actually what you're starting to do, and it's about sort of how the city region and beyond functions as an economy, not wholly in competition with London, but it is about, I go back to that point, about, for the UK as a whole, we need different parts of the country functioning effectively and providing that offer. And for me, that is the next step, really, for Manchester, and something that we're working incredibly hard on to try and get the right solution for that.
And it's my annual call that actually if we could be better in this country at considering infrastructure as part of real estate, or real estate as alongside infrastructure, that would enable those decisions and that funding to move a lot more swiftly. Yeah. Just related to that, and before we get into Q&A with the audience, guys, I wanted to ask about the green growth agenda, which has somewhat evaporated from the kind of more recent announcements. But particularly for those of us in real estate, we know that the net zero conversations, the pressures are there. But I think, Becky, you've highlighted the pressure on affordability, particularly, and it's certainly something we see in our funds, that often we need these trade-offs between affordability for residents and actually achieving net zero. And something you mentioned in kind of your portfolio that you're dealing with in Manchester in terms of housing and retrofit and how we tackle that.
Yeah, and I don't think we've got any we haven't got the answers on that yet, and I think we will be looking to the investment market to help us come up with some solutions. But I think, we have estimated that just to retrofit our council stock is going to cost about 375 million, and our rent roll is 62 million. On that basis, you know, we've also got to meet decent home standards and invest in those properties. We're never going to be able to do it, but the benefits of retrofit accrue to the tenant primarily. So how do we find a way to make that an investment proposition? And I think that's across the board. There are aspects of the sustainability agenda, elements of it that can generate a return, but there are parts that at the moment just do not stack up. And I would say that's the same with new development as well. In Manchester, there are still sort of issues around viability, and if you're pushing for affordable homes as well as net zero, you can push to a point where you don't get any development at all because the viability just isn't there. So I think we are, you know, I accept it can't all be grant funded by government either. I just, at the moment, don't think we've got the answer to this huge, huge and incredibly pressing problem.
Robert, Argent have been a pioneering sustainability-focused company since they were founded, and you've worked across the UK. What's your view on that side?
Well, we remain of the view that the climate change issue remains both important and incredibly urgent. So, and we believe that real estate has to have a credible path to net zero. If it doesn't, it's going to quickly become dilapidated. So we're already carbon neutral at King's Cross, and we have a path to net zero. It's complicated. It's going to require significant investment, but we're moving forward on that, and we've committed to being, net zero at Brent Cross Town by 2030, if not earlier. So it's hugely important to us, and it's hugely important to the value of the real estate we're generating and owning. So the importance of that has not gone away. It remains central. I think, I mentioned it earlier alongside affordable housing as two infrastructure challenges that cities need to address to remain credible, and I think that's absolutely right. And I think, I'm going to go back to my hobby horse idea of a London bond. You heard it here first. But for London, I think this is, we do need to raise more capital. And I think those of you who are involved in big projects, what's going to happen, what's happening now is that people are scrabbling around and looking at where they can offset their carbon impact by linking themselves to projects. They're not always picking the most efficient projects because they're looking at what they can grab. Whereas actually next door there might be a housing estate, or there might be down the road a housing estate, where actually the amount of carbon we can save through a retrofit there is much, much better gain for the money that's going to be spent. So it's just how do we link these things together? And I think the sort of mechanisms I'm alluding to could enable us to do that, rather than all of us making much more fragmented, inefficient decisions about how we path to net zero.
Absolutely. And I'll come to our chummy economists over there. But, Alex Sharma seems to have gone to ground slightly since October, but at the COP meeting in Glasgow, Mark Carney announced the GFANZ initiative, so the kind of Global Finance Alliance for Net Zero. There was huge amounts of tens of trillions being committed to achieving this, which was meant to fill the gap that Becca and Robert have outlined for us in kind of the how-to. Has that evaporated? From my side, we're seeing a lot of regulation around SFDR and TCFD requirements, and actually institutional pensions pushing much further ahead of regulation. But from a kind of broader economic perspective, Ian and Alexander, do you think the net zero kind of question is embedded in policymakers' minds, or is it a tick box still on the side?
I think it is embedded in the minds of business, and I think one of the things that I have seen across the business sector in the last kind of 4 or 5 years is that I think climate has gone from being about ESG to being a kind of core business risk, and so it's a key consideration for CFOs, and they understand the balance sheet implications of it. They're internalising the financial consequences of it and the business consequences of it in a way which I think means that it becomes not something which is kind of additional. It's just and obviously we're dealing with very, very large companies. I think that the rise in energy prices and the sort of focus now on energy security will accelerate a change. And I just think more broadly, we should think of it not just being about kind of individual measures, but I think this is it's kind of industrial revolution. And actually typically when you change energy sources, a society changes energy sources, that has sort of profound effects across the whole economy. You have to kind of rethink how production is carried out, how you structure societies. So I think this is going to be. So I think it is embedded. I think that proceeds in fits and starts, and there are going to be lots of dead ends. But I think it's one of those themes that we should, we can kind of lock into for a very long time. And I think just going back to productivity, I think the other interesting thing is that energy transitions are often associated with improvements in productivity.
Alexander.
Yeah, I mean, I think I agree with a lot of what Ian said. I think, the first thing business needs is a functioning energy market. I mean, shame on economists, really, because this is about the third time we've come up with these fabulously complex ways of doing things. The railways was another example. Financial regulation a while ago was perhaps another one. And we kind of, apart from people like Dieter Helm and maybe Ian, there's very little contribution to the debate as to how to fix some of these problems. So we need to, as economists, think about that. But we do need a functioning energy market. One of the advantages of doing that is that it would, this energy crisis has demonstrated this, is actually the more sustainable forms of energy are lower cost now than the marginal price of natural gas. So if the market had been allowed to function, without sort of ending up where it has, you would have seen natural price signals coming through, which would have stimulated investment and the switch to sustainability. The second thing I'd say is that let's not forget, again, coming back to my sort of tactical approach, that cities such as Manchester and London have the lowest environmental footprint for the amount of GDP they produce. So cities are fundamentally good places to get low carbon output. It might surprise us, but I promise you, according to the ONS, it's true. And therefore, London Property Alliance and the bids and others, we need to be making the case for sensible policies on retrofit, on unlisted buildings, which are tricky. And we're working with Westminster City Council on a sustainable buildings charter and doing something on the skylines, sustainable skylines thing with the City of London. So we need to find a way of, again, delivering on that agenda in a way which the market will accept from a value for money point of view, which will in turn drive and help London contribute to this broader government and objective. And what I would say, though, is that we mustn't lose sight of the fact that when we're making decisions around, for example, redeveloping existing sites versus rebuilding them, that those buildings, and there's one leading, other supermarkets are available, but there's one on Oxford Street, isn't there, which comes to mind, where actually, we do have to think about the fundamental attractiveness and competitiveness of London when we are making those decisions, not just about the immediate carbon impact. In other words, what do our buildings do to contribute to London's broader attractiveness and its ability to attract and retain capital and talent and so forth. So I think it's a very exciting agenda for big cities on this front. And again, we need to work hard to respond to the government's agenda and say, we can help you to tackle this problem. These are the things we need in order to do that.
The challenge being getting an agreed template of what those solutions might be in a market, whereas Becca highlighted it's very granular and it's not always there's something that you can roll out. Okay, we're going to ask our roving mic friends to stand up and wave and so people can see them. So I've got a lady over here. There. But ladies and gentlemen, please put your hands up, nice and straightforward with questions. You know that I will pick on people if I have to, because I know lots of you out here. But that's fine, I can also keep firing questions. So please do wave if you've got a question for our esteemed panel.
Alex, while we're doing
Go on.
I'm slightly perturbed by how much our economists are agreeing.
I know, me too.
Because in the old days, we used to have, going back a few years when Argent started, we used to have Roger Bushell for capital economics and Dennis Turner from HSB along to the same board meeting. They used to present the same data to us with wildly different conclusions at the end. So that tends to be more my experience. So I will get slightly perturbed when the economists are agreeing.
I know, I'm with you on that. Let's go back into that. I've got one over here, we'll come to. Can we get the microphone to the question over here, please? The back row up there. If we could get one over there. But on that carbon point, a lot of carbon analysts would argue that actually if we could flip the kind of approach to being more about resource efficiency, it could actually be a process that's saving. So to Becca's point, instead of looking at a rent roll and a vast cost, if we could just get that kind of looking at it as a resource efficiency process, that we could actually do it better. But within real estate, when we've got a fairly archaic system of construction, supply chain, how, is that something you think we can feasibly tackle, or do we just have to?
Well, I think what we're seeing is, I think what you'll partly see is real estate growing out into associated areas in the same way that a lot of real estate companies didn't necessarily get involved in wider issues of placemaking or affordable housing a few years ago. Now they're core business, and I think energy now becomes core business. So, we're doing deals with solar farm providers and landowners, and we're buying forests and planting forests as part of our agenda. That's not what we started doing. So I think what you're seeing is a sort of growth of real estate to bring in these associated areas. And one of the things I'm struck by in looking at some of these deals that we're doing in the issue of renewable energy and so on is a lot of the companies that we're dealing with, whether it's to do with anaerobic digestion or other technologies, is that they're actually relatively thinly capitalized companies compared to the King's Cross estate, for example, or other forms of other companies. And so, but we're totally reliant on them performing to hit this huge agenda. So, I think there might be a better way of real estate embracing the agenda more, actually, because I think that, it's quite an embryonic sector, and we're seeing an awful lot of change. But you're right, the higher pricing will ultimately, although it's a bad thing from a consumer point of view and affordability, it is going to trigger a wave of investment in that sector, which ultimately will come through and improve resilience and be part of the decarbonisation.
So as ever, we're good at talking about collaboration, but not necessarily good at actually doing it.
I think you'll see real estate stepping in, is what I'm saying.
Okay. Lady at the back there, if you could give us your question.
Hi, I'm Quinn Fan from Southwark Council. My question is that Sir James Bevan, Chief Executive of the Environment Agency, last year gave a speech to Whitehall saying that more net zero won't be enough, and all of you have been speaking about achieving net zero. Are you going to wait for the government to implement net negative, or are you going to set the set the curb?
Okay, so there's a question around net zero not being enough, and actually is the industry going to wait for kind of regulation to drive that, or are we going to push that through? So I guess from a public sector point of view, you guys have got quite strong targets and you're set to stuff already.
Yeah, and so we've got a science-based climate change strategy within the city, and I think it's quite a sort of bold thing to do. Within the city council, we're on target to meet our target. Within the city as a whole, we are absolutely not, and we know that. I think there are lots and lots of pressures there, and we've just refreshed our climate change framework for the city as a whole. And, it's going to require actions from a whole range of partners. But I do think that fundamentally, we are all making trade-offs, aren't we, in terms of we know we need to be doing more here. But as I touched on it before, when you've got development, for example, that is marginal, and you start to layer on additional requirements, do you not have the development, or do you accept some degree of compromise? However, I would also say we know we need to be doing much more. And I think this comes back to the investment point. Until we've cracked a way to make it more viable to deliver this kind of investment in existing stock and new stock and sort of in our transport network and beyond, we are always going to struggle with this. And as a local authority, I would also just flag it can't all be down to a local authority. Everyone looks to the public sector, but we've also got, adult social care and children's services to run all at a time when the public sector has seen huge underinvestment and real-term cuts for many years. I think, Robert's reference to local offsetting is something that we're already sort of exploring. I think, that could be part of the solution. I think innovative investment mechanisms that cross-subsidise some of the investment that can generate a return with some that can't is another solution. But at the end of the day, I've said it before, we don't have the answer. We've got targets, we are doing what we can within our gift as a council, but a lot of it at the moment is beyond our reach.
And I think, Robert, the question is highlighting that net zero isn't kind of a finite target that you reach and you tick and it's done. And one of the complexities in kind of real estate where we have customers, we don't have direct control, and nor should we, particularly in a residential context, and it's so granular. So that can be somewhat overwhelming to approach, and perhaps where you and I sit in the kind of long-term investment space where we can take that placemaking gain over time versus the more kind of traditional trading markets. How do you think those lessons can be shared?
Well, I think in a way, first of all, I agree with the question, but net zero is hard enough, so let's not make it impossible. I think, if we can get to net zero, I think that's a hugely ambitious target, frankly, and how quickly we can get there. I don't think the industry, certainly from what I see, is waiting for regulation to drive it. I think a lot of people are making their own decisions about what's right for them and where they want to be relative to their competition. And certainly we're very clear about where we want to be. And in the end, it's part of the attractiveness of the places we're responsible for compared to other places, frankly. So we're not waiting. And I think the same is true of cities. When I go to conferences like this and when we go to other ones that we're now allowed to go to again, what you see is cities collaborating more and more. You see city networks developing. You see cities like Manchester collaborating with, yes, London, but other cities around Europe. We're not waiting for governments to sort this out, actually. Cities are driving the agenda in many ways because we can't wait for governments to give us the answer. So I think you are seeing more of a sort of ground-up network as well. On your point about trading versus the long-term players, I think all of this is actually, in a way, playing into the hands of the long-term players, and so it should. I'm a firm believer in that model. We have more tools at our disposal to sort this out, and so I think it's a better model.
Absolutely. So we're in the right bit of the market.
Absolutely.
We're okay. Okay, good. More questions, ladies and gents. If we could just have a hand up. There's a gentleman here at the front, please, and then there's another one over there. I think if we could just get this one down here. There's a microphone just coming to you. And if we could get the microphone. Have you got a microphone already?
Yeah.
Go for it.
You've talked about the importance of connectivity. Rail has got a much reduced ridership at the moment. Do we have to rely on rail? It's enormously expensive to do. It's fixed, it's not flexible. What do you think about that?
Right. Do we have to rely on rail? It's enormously expensive, slow and fixed. And so, yes, we've had the kind of Crossrail 2 versus Northern kind of connectivity lack of other transport solutions. Alexander?
Well, I'm glad you've raised it because I thought we were going to spend most of this session talking about home working. And it hasn't even come up, very oddly, until now. Thank you for the planted question. I think that this is, if I can say, the rail, I think the answer is yes. I think rail is fundamentally a very sound and safe and environmentally and city-friendly way of moving people around. We've also got lots of it, which we have to somehow think about. We're either going to use it or not use it, to put it bluntly. And London in particular is, the London Underground and its suburban rail system are absolutely have been fundamental to its success and growth. And other cities around the country are, busy trying to get or expand their existing networks, such as Manchester Metrolink. So there are lots of good reasons for having it. The issue of home working or hybrid working is going to, and already has, created huge headaches for public transport because of the pick and choose approach that people are now taking to when they want to use it. And quite unhelpfully, the fact that people are choosing to come in on 3 days a week is a total nightmare if you're a railway operator, because it means you've got to design your system and service for a peak, which used to be 5 days of the week and is now 3 days of the week. So it creates lots of headaches for them. And I actually think that we need to get ahead of the curve on understanding the impact of all this stuff on productivity and growth. And my strong hunch is, and it's no more than that, is that we are not going to end up with a 3-day-a-week model. I think that when and the BIDS and others are going to do some work on this with Professor Dan Graham of Imperial and others, when we understand what the impact of hybrid working is on the agglomeration economy, so the benefits of having lots of people coming into a small space, so you can have lots of accountants from different specialisms coming from all over London and the southeast into one place. That creates these so-called agglomeration benefits, productivity gains. And if we find that this model has weakened that, I think we would be right to question government and others and ourselves as to whether we want that model to persist. And one of the key findings from some work by King's College recently was around 60% of people say that fares and commuting as such are a key driver for the reason they're working at home. So if we could do something with fares, which is within the agency of government, we could potentially get people back into the offices more often, which would have that productivity gain, and actually would tighten up London's long-term sustainability credentials, because at the moment what we're seeing is London's commuting network drifting further and further out, and I'm not sure what that's going to do for net zero and sustainability either.
Thank you. Ian, last year I remember you had some interesting stats about the kind of the reality of return to work numbers, and have you been monitoring that at Deloitte over the past year?
So far it does look like a really big step change in behaviour, but I mean, I think that, you know, this is a huge experiment, and it's an experiment which is, you know, it's been obviously occasioned by the pandemic. It's caused people to change how they, you know, how they work and live, and it's been against the backdrop of a very tight labour market, and based on the assumption that people can be as efficient at home as they are at work. And we don't know the effect on productivity, frankly. I mean, there aren't data. There are different surveys and there are different opinions. And I think that it's going to take quite some time to work out, you know, the kind of benefits you talk about. And I think when we all talk about hybrid working, we come up with lots of reasons for getting together. But I don't think we've reached an equilibrium. I really don't. And so I think it would be premature to say this is the way it's going to stick.
Can I just add one point very quickly? The trouble with agglomeration economies is that they are experienced at the sector level, not at the firm level. So all these surveys which are asking individual companies about and their workers about, are you more efficient and so forth, which come back saying yes, especially the ones, you know, people who are working at home. The problem we've got is that there is a risk to overall productivity, which those firms won't individually experience, but which will be felt at a sector and therefore at an economy level. And that's why we need organisations which look at sectors and competitiveness and the way the city's economy is working more generally to focus in on this issue. And the second thing, very, very quickly, is it is not a consistent pattern across all world cities. Hong Kong, Paris and Berlin have much higher levels of office occupancy compared to London and New York in particular. So it is not I think, a given trend, and it's certainly not one which is shared universally.
That may be a function of longer distance commuting.
It may well be. And therefore we've got to think about
how that plays in. Nobody's mentioned airships, which was what I was hoping you were going to come up with. But okay, gentleman in the front here.
Hi there, Tim Burgess from Todd Architects. I want to ask the advice that the panel would give to a young school leaver who was coming to them saying, this built environment real estate business looks really, really interesting. Where would I go to make the most positive impact in the future? Which part of the industry would I work in?
Okay, which part of the industry would you recommend working in, obviously apart from ours? What's the bit that drew you into it, I guess, and where would you recommend a school leaver should look to go?
So I ended up in my job completely by accident, I've got to say. I did politics and modern history and didn't know what to do with it, so I started working for a council. But I wouldn't have it any other way now, and I think I have got a great job. So I've lived in Manchester since I went there for university. I've never left because I love the city, and now I'm responsible for its growth and development. You know, I think local government in particular, you do get people that sort of want, it's the place shaping bit that I love. So I'm not an economist. I can't claim to understand all of the sort of financial instruments that some of my colleagues might. What I love, what gets me out of bed in the morning is seeing developments come forward that may not have come forward without me and my team. And it's you know, that will be kind of what sort of draws people in, I think. And we have got some success, I think, in bringing people in, despite, you know, far more competitive salaries in the private sector. But, you know, it takes a certain kind of person to do that rather than sort of, you know, work for an architect or a planning consultancy where they could get far more elsewhere.
I think all our architects and planners would say that they are not being as well paid as you think, but that's okay. But, you know, tell me if I'm wrong. But that's good. Robert, you know, in terms of what you'd recommend a school leaver, because I think we've for too long been in that kind of surveyors in this box over here, planners over there. It's a much more fluid industry now, isn't it?
It is, and that's a good thing, and we're all focused on making it a more diverse and inclusive industry, and that's important. So I'd like to think your school leaver might come from, perhaps a more diverse background. But I mean, obviously I'm going to recommend development. I mean, I'm bound to. I think, we're engaged in creating places and making things. We're, to an extent, a manufacturing industry. We have the ability to working with partners. Very often we're in partnership with the city council or the public sector. So, hugely important. People do want to work for our local government and public sector. But we get involved in, creating and shifting things. And you can create things and see how the city changes. I remember when we opened the King's Boulevard at King's Cross and just saw how the pedestrian flows just changed and how the city just felt differently. I mean, you can't beat that. So, I mean, I think get involved in development, send them our way.
Okay, Alexander.
Well, I worked for 11 years with Arup, and I was always jealous of the people who actually made real things that you could see on the skyline. So, much brighter than me, and I'm not just saying that for effect. I mean, some of the numbers which go into structural design. So I would say building engineering and design, because all the other things that people like me do are periphery to having high quality, sustainable, competitively designed buildings which people actually want to occupy. So it's key to the market working. And I think there's lots of exciting change going on there now with laminated timber and new materials and the whole debate around refurb versus redevelopment.
And Ian, you highlighted in your keynote the kind of proliferation of jobs within the real estate sector. So are there particular bits that you think are kind of going to be for the children of the future to come into?
I don't know the questions of that. I mean, actually, I was on the 13th floor of our new building in 1 New Street Square with a client yesterday, and we were looking out over the skyline of London, and he said, this in the last 40 years is almost unrecognisable how it's changed. I mean, I suspect all economists kind of regret they didn't do a real job where, and so I would say architecture, town planning and design. And I think that, on King's Cross, did you? Oh, you found a better job.
No, it's very important.
But you go around King's Cross and you see I mean, I've been living in London 40 years. You see the transformation that can occur, and I really do think it is exciting. So, yeah.
I'm delighted. I didn't even have to plant a thing about the importance of placemaking, but it is all about that quality of place and the tangibility of real estate. I think, guys, we're kind of run out of time, but we've covered so much in a short time, but that idea for me that sticks around net zero as a new industrial revolution that Ian gave us, and that productivity kind of very reassuringly is not about London failing, but actually all cities in the UK being much more collaborative and all pushing and that growth agenda in the ways that Becca's outlined for us. Those linkages that we've talked around affordable housing, infrastructure, net zero, more connectivity as a whole across this space, and the argument that we could maybe have more efficiency to help us on that kind of net zero journey. And that the hybrid issue isn't settled yet. One point I was thinking when you were talking about that productivity point, Alexander, that the Centre for Social Justice did a study before COVID that showed that they interviewed all UK employers with more than 1,000 employees and found that 49% felt that they had productivity issues within their business because of poor housing for their staff. Yeah. And so actually for me, I think it's that where kind of you started, but that link between the need to address affordable housing and the impact that has on our productivity in our cities. And you touched on it as well, Becca, that we must be a bit more holistic and not just these kind of silos of asset classes. So I think there are some surprisingly optimistic things to think about there, especially if you're in the kind of long-term placemaking. We'll kind of stick to our guns a little bit and perhaps not book the US holiday quite yet, but hang in there that it's worth doing. Thank you for those of you who are brave enough to ask questions. I'm very delighted that we've had such a wonderful panel, so please join me in thanking Ian Stewart, Alexander Yan, Robert Evans and Becca Heron.